Well, today I'm answering a question from one of my subscribers. How do I pay off my mortgage in 15 years? Now, this is a really great question because I don't have an app built for that and I don't have a spreadsheet. So I decided that I would make one. And as always, I haven't done my intro. I guess I should probably do that. I'm not a financial advisor. I don't work in the finance industry. And my name's Levi Woods. This is an opinion channel about money. And the reason that I have the channel is to help people like you make more money and to build more wealth. As you guys know, I love to build charts, and we're gonna do this again for the second time because somehow I wasn't recording my screen the first time around. So today we are going to look at percentages. I built this little chart to show percentages, to show the amount increase of extra payments. Basically, the reason I built this is because I wanted to show how difficult it is to pay off a low rate mortgage. Now, I have subscribers from all over the world. I have subscribers in Australia, Canada, United States, and every country has different mortgage payments, different mortgage structures. What ends up happening is I need to create charts that work for everybody. I need to create spreadsheets that you can input your own data, and that's exactly what I've done. But before I get into the actual chart, I just want to show you how the interest rates function and how it makes it very difficult to pay off a mortgage in half the time if the interest is low. So let's take a look at this. The original mortgage value, this is where we're calculating right now, $400,000. The original term, 360 months, which is 30 years. Now, if somebody wanted to pay off that mortgage in 15 years or 180 months, just did a quick calculation here, if their mortgage was only 2%, now I know for Americans this is like unrealistic, but for Canadians this is totally realistic to have low mortgages. Normally monthly payment would be $1,478. The extra payment would be $1,093. The extra monthly payment would have to be 74% of the normal monthly payment. That's an extremely large amount of money. Now, in contrast, if you scroll down just to 6%, if we look at that, the normal monthly payment is bigger, $2,400, but the extra amount of money to pay it off in half the time is only $972. That's an increase of only 40%. Now, of course, you're thinking, well, yeah, but they're automatically paying a lot more. Well, the thing is, in countries that have low mortgage rates, the housing is very, very expensive. Let's look at this example. In the United States, I get lots of subscribers that say, oh, I have a mortgage of $200,000. So on a 6% mortgage, the normal monthly payment is $1,199. So $1,200 a month. That's the normal mortgage payment. To pay it off in half the time, a total of another $486. You're looking at a total payment of around $1,700 a month. In Canada, the houses are just way more money. So if you're moving into a similar house, you could be looking at like a $400,000 loan. So all of a sudden, a $400,000 loan at a 3% interest is the base payment is $1,700. That's what the Americans were paying with their extra payment. And the extra monthly payment here in Canada, so now would have to be $1,000. So what we're looking at is a payment of over $2,700 a month just to pay it off in half the time. It's because this payment is increased by 63%. Now, if you scroll down to the bottom, I went really far because interest rates in Canada in the early 80s when I was young were 18%. My parents were paying an 18% mortgage. At that time, the values of the homes were way less, and maybe you had like a $50,000 mortgage. And so the normal monthly payment was $753, but they only needed to make an extra payment of $50 to pay it off in half the time, or 6.7%. So it's an absolute no-brainer if you have a high percentage mortgage, and high being anything above 6% in my mind, make these extra payments because it pays it down amazingly quickly, like with very, very little money. On a $50,000 mortgage, like look, you're paying your normal payments $300 and you only have to pay another $120. That's pocket change for most people. They can just make that extra payment. So what we're going to do is we're going to look at this the mortgage-free goal calculator, which I created. So this doesn't use the original amount. This uses an arbitrary amount, whatever we owe today. So we can look that up online. You log onto your online banking and you enter this data. So let's say I have an outstanding balance of $239,345. Annual interest rate is 4.5%, and the current regular payment Now, if this doesn't show you on your online banking what your regular payment is, which it should, but if it doesn't and you need a little help, I've also included a little calculator here, which calculates a normal monthly payment. Let's just say we're looking at a $239,000 loan. Let's say the original value of this loan was $250,000 and the original term was 360 months, 4.5%. Then the normal monthly payment would be $1,266.71. So that's the number we're going to take from this, $1,266.71. We're going to put that in, $1,266.71. Hit enter. It tells me right now that current payoff in months is $329, and the current expected interest I'm going to pay is $177,000. If my goal is to pay it off 15 years from today, then that's what I'm going to enter. I'm going to put my goal in here. I'm going to months to pay off. I want to pay off in 180 months. Hit enter, and it's going to say that over and above the $1,266 that I'm normally paying, I'm going to have to pay an additional $564. But because I'm paying that extra, my new interest cost is only going to be $90,000. I'll have an interest savings of $87,000, which is pretty amazing. Now, I was building this and I thought, okay, that's great, but what if we want to figure out how long or how much we're going to save time-wise if we just put in an arbitrary extra amount? So I did an extra little thing here so you can calculate it a different way. What if we just calculated an additional monthly payment? Say we did $100. If we put that in $100, then instead of paying off the mortgage in 329 months, we would pay off the mortgage in 286 months. We'd have new interest cost of $151,000 with interest savings of $26,000. So this gives you two different calculations in the same chart, which is pretty amazing. And you can just play with your own numbers. You can put in a 6.5% mortgage, and it will give you errors if the information isn't right. Your regular payment can't be too little, otherwise it will error out. But this will calculate out. If you had $239,000 remaining at a 6.5% and your regular monthly payment is $2,000, then you're going to pay off in 193 months already. But if you want to squeeze some of those months off, you have to pay an extra $84. Anyways, that's it. That's how the chart works. Super, super simple. So if you guys are interested in getting it, check out the description below. I'll put a link to my Etsy store, or if you're one of my patrons, you can go to Patreon and you can subscribe to my monthly trades, and you can follow all of the trades that I do so we can all get rich together, and you can download these spreadsheets from there as well. Thanks so much for watching, and let's get rich together.